this is chapter 16, which covers the writing requirements in order to make some contracts enforceable. Otherwise, if some contracts weren't put into writing, they would not be valid. So this entire chapter revolves around this statute of frauds right here that basically explains that there are certain types of contracts that need to be written down in order to be enforceable. So these contracts include contracts dealing with land, right here, contracts that by their own terms cannot be performed within 1 year after being created, collateral contracts, promises made for marriage, and contracts for the sale of goods over $500. So this chapter goes through those each at its own time. So contracts involving interest in land, pretty self-explanatory. If these people make a contract to sell land, they have to have it in writing in order for it to be valid. And this is a great example of a contract being written down and following the statute of frauds, where this couple made an agreement to sell property to another party, and there was an agreement made that a $350,000 non-refundable down payment would be made. And so that down payment was made, and the buying party ended up backing out of the contract, and they could not get their refund back because the contract followed the statute of frauds and was written down. So therefore it was enforceable. Another contract that requires writing in order to be enforceable is one that follows the 1 year rule, which basically means any contract that by its own terms cannot be performed within 1 year after being created must be written down. And that's because people's memory is very unreliable after a year. Some specifics about the contract could have been forgotten, so for that reason it must be written down. Another must be in writing contract is a collateral promise, or the promise to assume debt for someone else. The only exception to this is the main purpose rule right here, and that's if the person promising to assume debt benefits from doing so. And I didn't really understand what that meant, but this example right here explains that a businesswoman, or hopefully a business owner, went to a manufacturing company and asked for some machines to be custom made for her factory, and then she went to the supplier of that manufacturing company and promised that they would be paid. So she is, in an oral promise, agreeing to take on the debt of the manufacturing company should they fail to be able to pay the supplier. But she is benefiting from this promise because she's getting the custom made machines. So if it went to court, the promise would be enforceable even though it wasn't in writing, because she benefits from taking on someone else's debt. Any promise made in consideration of marriage that involves a monetary or property payment needs to be put down in writing. This also goes for prenuptial agreements. So any agreement that the two involved in the marriage, if they should divorce, which would be unfortunate, they will both get to keep their property. That needs to be in writing in order to be enforceable. And finally, contract for the sale of goods. This is just a uniform commercial code included in the statute of frauds provision that says anything for sale over $500 must be in writing to be enforceable, and also must specify the quantity of the goods, because otherwise the contract is not enforceable for any quantity more than what was guaranteed by the contract. So there are some exceptions to the writing requirement, and these include partial performances, admissions, promissory estoppel, and other special exceptions under the Uniform Commercial Code. So partial performance is basically if where is it? Oh, right here. Okay. Basically, if a contract was only partially performed and both parties cannot return to the state that they were in before, then the court can grant a specific performance, and this is basically a remedy that requires the performance of the contract to be carried out according to the terms that were set before. Another exception to the writing requirement is admissions. So if any party admits at any time during the court proceedings that there was an agreement reached of any kind, then it becomes enforceable even if it wasn't written down, because both parties admit that an agreement was reached. This promissory estoppel basically means that if the party whom the contract is being enforced did so justifiably at their own detriment, then even if it wasn't written down, the court can enforce that contract. And then this just explains other special exceptions under the Uniform Commercial Code, such as oral contracts for goods that are customized for a certain buyer, and things of that nature. So this section here covers what exactly is sufficient for the writing of a contract. So a written contract needs basically terms of the contract and some signature or form of evidence that both parties agreed. Now, this form of writing can contain anything from confirmations, invoices, sales slips, checks, faxes, emails, or a combination of any of those documents, which can, as long as there is an express referral to an outside document, that pulls the document into a piece of the contract itself. So parole evidence is something that happens when an oral agreement and a written agreement are both set in motion but have conflicting terms. So, for example, here in the text it says, if a landlord tells a tenant that they can have pets, and then the agreement that the tenant signs says they can't have pets. So this is allowed for in the court by a proceeding called parole evidence rule. So if the court decides that the written contract contains final statements of the parties' agreement, then parole evidence is denied. There's no reason to use it. But if this is not the case, then parole evidence can be brought forth. This is all exceptions to parole evidence right here. And down here, we have integrated contracts, which is basically parole evidence being brought into the original contract as an integrated contract to make up for the terms that were conflicting. And finally, we end with the statute of frauds in the international contract context, which basically summarizes that there's no provision for the statute of frauds in international transactions.